With how inflation's at a high these days, we're all concerned about how it's going to impact the stock market, but that's not the only concern some of you might have about this. In these trying times, you might even be thinking of how you can benefit from the skyrocketing inflation and its subsequent effects on the stock market. What's the best way to get the most out of this? We'll dive into that in today's video. The NASDAQ dip. For those of you unaware, NASDAQ is America's second largest stock exchange based in New York City. A dip in the stock market refers to a short-term decline of an asset's monetary value. Now, traders and investors consider such a decline a great opportunity, and that's because if you buy or invest in that stock when it's facing a dip, you might end up facing some really good gains in the future, in the event that the price for that particular stock climbs back up. Okay, now that we've got that out of the way, let's talk about the dips NASDAQ's facing right now. Right before a very important meeting about inflation, the company's stocks took a hit this Tuesday. The NASDAQ composite was down by about 1.19%. NASDAQ's chip stocks continue to struggle as inflation looms on the horizon. Chipmaker Micron had already forewarned about these dips on the market, taking into account the various microeconomic factors as well as the constraints on the supply chain. All the figures indicate one thing: inflation's bringing trouble for corporate America. And chips weren't the only stock to face this terrible hit in NASDAQ. A couple more NASDAQ-listed stocks ended up facing some damage too. Novavax faced a drop of almost 30% because their COVID vaccines don't seem to be cutting it out there with the poor demand. And then we have Upstart shares facing a horrible plunge of 11%. How inflation impacts the stock market. You can't always be certain about what kind of effects sudden rises in inflation might have on the stock market. It can be good, it can be bad. Generally speaking, inflation spells big trouble for corporations because interest rates soar in times like this. It's an awful time for companies to take out loans, and that's where all difficulties begin. Companies have products to sell, and to make these products, they have to buy all the necessary materials. Unfortunately, they can't exactly borrow money because they'll face a big loss. And then there's the fact that with inflation, consumers end up buying less. So there it is. Any company in this situation then resorts to lowering the value of their products. A big hit for sure. Now there are two kinds of stocks. We have the value stocks and the growth stocks. Value stocks tend to have stronger cash flows and their rate of growth or decline over time is rather slow. Growth stocks, on the other hand, are stocks of fast-growing companies and usually is not a big profit to invest in them. In times of inflation, it's considered better to invest in value stocks. That way you won't see any abrupt changes and face any kind of unforeseen losses. The mistake of buying on impulse. The stock market is no joke, folks. It's serious business because we're talking about money here, and like they say, money doesn't grow on trees. So don't be impulsive and make a spontaneous purchase because who knows how it's going to turn out in the future. If you're making an investment, might as well make one that would bring you good gains, something that would be worth it. People who've been looking at the stock market for years know that such huge declines scream clearance sale, but even they don't immediately buy a stock when it faces a dip. You should look at your own financial circumstances before making a rash decision to buy a stock that just faced a little decline. Ask yourself if this really seems to be a good time to invest all your hard-earned money. Also consider how volatile these growth stocks tend to be. A better alternative is to invest that money into a savings bond. These require a minimum of $25 as investment, and the good news is they're backed by the U.S. government, which means you have complete security and certainty in your investment. Often, the smartest move to play is to wait for the trend to reverse. You need to practice patience and watch if the market remains steady, even when the worst hits. It indicates that investor confidence is intact, and you're good to go with that investment. Research is your best friend. Ignorance might be bliss, but the stock market's the one place where it's definitely not a folly to be wise. In fact, be the wisest you've ever been before making any decision. This means that you must, at all costs, conduct thorough research. Look up companies with investable stocks. How can you know if the stocks are worth investing? Well, you've got a lot of reading to do. Dig out their reports on quarterly, as well as annual earnings. Check all their balance sheets and income statements. Not just that, take into account the company's price to earnings ratio as well. They're all important figures to consider before you invest your money in their stocks. A high price to earnings ratio means the company went through a great period of investment. On the other hand, if the ratio is more towards the lower end, then that indicates how cheap their shares get when the company hits tough times. You shouldn't just look at the trend in the general market. It's vital you focus on how well the company itself is faring in the business, because you'll have to go through a bunch of reports. Here are some important figures that might help you decide if the company's shares are worth investing in. Climbing cash flow, low debt, good earnings growth, great manageable and favorable business trends. Keep your eye on the good stocks. Whenever inflation rolls around, stocks are affected in a manner of ways, which is why you should be on the lookout for the good ones. They're a tad bit difficult difficult to spot, but they're there and the investment's worth it. Rule of thumb is that the value stocks we mentioned earlier tend to be the best ones to invest in during periods of inflation. To figure out which stocks are doing good and are the best ones to invest in, keep an eye on companies which are still getting in purchases on their products from consumers, despite the products being more expensive due to inflation. This shows the strength of a company's shares is stronger, and it definitely means a safe investment. Some examples of such companies include food and drink companies, companies involved in healthcare, any business that's selling household items, or companies responsible for utilities like gas and electricity. They're your safest bet when it comes to investing your money in shares during inflation. Investing in all the right assets. Certain assets do really well under inflation, and there's a reason why they tend to perform better under such circumstances. These assets bring in more cash when inflation's on the horizon. The value of such assets also tends to increase during inflation. The best example is that of rental properties, because these see a rise in rent. Another example is of energy pipelines, whose rates are subject to increase with inflation. You can also turn to real estate. When inflation hits, real estate turns into a pretty good source of value, and like we mentioned before, there's the increased rental income factor. But be wary though. Inflation means increasing interest rates, so real estate can be a hit or miss, so weigh your decision before you invest. There are certain commodities that are considered great to invest in. People often go for gold or other precious metals. Inflation means an increase in the price of these metals, and that's always a plus point. The long-term consequences. As an investor, you should always consider what the long-term implications of your decision will be. Companies face short-term swings in their values, and good investors ignore that because they know the trend. A good investment means there will be more buyers on the market. When investors keep their share for a long time, the value for said share climbs. In the stock market, that's a great thing. The fact also stands that inflation isn't here to stay. Market trends change and fluctuate just like the seasons. If the interest rates climb, consumers are going to stop buying. Demand will be reduced, and as a consequence, there will be a decrease in supply. This is where recession comes in. Basically, what it means is that for a couple of months, production's going to be pretty low. When recession hits, your best bet is defensive stocks. These are stocks that consist of products consumers will continue to buy because they're necessary. An example include grocery stocks. Considering this trend, you can see how investing your money in defensive stocks will produce big profits for you in the future if you factor in recession. Eventually, both inflation and recession will stabilize and the economy will boom. It's just how this goes. That's a wrap for this video. Want to hear more about how you can benefit from the stock market in these times? Let us know in the comments below. Make sure to give this video a thumbs up and subscribe to our channel for more videos like this. See you in the next one.